Welcome to Mongo Space. Really interesting discussion today on understanding SIB, Mansa-X, and just markets in general. I'm Eric Mokai, the founder of Mongo Capital. So, Nashon, maybe you can introduce yourself to those who don't know you, and then you can tell us a bit about your work also.
Good evening, everyone. Mongo, thank you very much for having me. My name is Naashan Mungai. I'm the Executive Director for Global Markets at Standard Investment Bank. And I'm very happy to be here this evening. Looking forward to an engaging conversation.
So, Nashon, maybe you can tell us a bit about what you do day to day. What are some of the activities you engage in? And also tell us a bit about the background to SIB, a bit of history around the company itself and how you got there yourself.
This is the second time I've been here before, so thank you so much again for this opportunity. Within SIB, I run the Global Markets Division. This is a buy side of the business, and I'll explain what that means shortly. At the buy side of the business, where I run discretionary funds, the one that's most well known is a Mansa-X fund, and I think that's the one we'll be discussing mostly tonight. I joined the SIB from commercial banking, actually. Before I joined the SIB, I worked for various banks, but mostly in trading capacities in the treasury departments of I&M Bank, Equity Bank, KCB, and Bank of Africa before I left, where I was the head of treasury. So in my capacity in those commercial banks, it was really just fund management, but in a very different angle from how you might know it. It's really what happens within banks is that traders actually trade the deposits, clients' accounts. Traders are actually the ones that actually trade those funds, and that used to be my role for about 6 years before I joined SIB. So I joined SIB to give opportunities to investors to access markets that were not before exposed to investors in the Kenyan space.
And what's SIB's core business model? What are some of the services you offer?
So SIB is an investment bank. So just to explain, an investment bank is different from a commercial bank in the sense that an investment bank that does not take clients' deposits like a bank does, because a bank takes in clients' deposits in order to on-lend them as loans, and the margin of how much they pay their depositors versus how much they lend is actually how they make a return, or that's how they make a profit. Investment banks operate in the capital market space, meaning that we enable our investors to participate in stock markets, fixed income markets. So fixed income refers to the buying and selling of bonds, treasury bonds, bills, and so on. And also investment banks primarily, although this was not happening for a very long time in Kenya, enable investors to have access to financial advice, advising them in terms of how to manage their wealth, what you call wealth management and advisory. So investment banks help retail investors to participate in capital markets, but they also help businesses in capital raising. So if you're a company and you're looking to raise money by, say, listing on a stock market, investment banks such as Standard Investment Bank will enable you to do that.
And what differentiates you from the other investment banks in the market in terms of value proposition to clients?
So Standard Investment Bank was founded in 1995, and it's a fully indigenous investment bank. So we've been around for a while, over 30 years now. And we started as a stockbroker. So for a very long time in Kenya, we did not have a very big differentiator between an investment bank and a stockbroker. And I'll explain what this means. In the stock brokerage business, it means Mokaya comes to buy Equity Bank stock. So when you buy Equity Bank stock, then you come and buy it through, say, SIB. And then we will help you to buy this stock. We will place the order for you. And when you buy, we'll earn a commission on that trade. So typically around 2%. So for a very long time, that's what investment banks in Kenya did. And the trouble with that is we did not really do, as an industry, that is, we did not really help investors with managing their wealth, because if you buy an Equity Bank stock and it doesn't perform well, that's up to you. We don't really do the job of advising you on whether it's the right stock to buy or whether it fits your portfolio and so on. So around 2016, the board of SIB sat and decided we need to do business differently. Can we start also managing funds and discretionary fund management of investor funds that are given to us, so that we can actually do the job of helping investors make the right calls in markets, because we have an advantage based on our experience, and also because we have what you call an order flow exposure. So we're able to know maybe the stocks that are best suited for you. But we took it one notch higher to then expose investors to actual investment classes that do not necessarily only exist in the Kenyan space. So what the value proposition for SIB therefore will be that when you enter SIB, SIB, you can do the very things any other investment bank can give you, because any other investment bank can do the same thing. They can offer you stock brokerage services. They can offer you access to corporate finance businesses, what you call balance sheet optimization, IPO listing, mergers and acquisitions. They can give you all that. But we decided to take it a notch higher by now allowing retail investors to actually come and not have to do anything other than just invest with us. And we do the rest of the work, that is investing in various asset classes on their behalf. And that's our biggest value proposition, the fact that we became an all-rounded financial advisor, so to speak.
So apart from Mansa-X, which we're going to dig into in a couple of minutes, what are some of the other products that you have? Maybe you can just mention a few that people may not be aware of.
So let me just first of all explain that an investment bank, even from a regulatory perspective, has to have a sell side and a buy side of the business. The sell side of the business is where we receive orders to buy and sell financial instruments on behalf of investors, essentially what I referred to earlier as a stock brokerage side of it. So investors can come and open accounts to buy and sell shares on the NSE. So that's the first thing they can do. The second thing is they can come to us to buy and sell fixed income assets. So you can buy Kenyan Treasury bonds with us, Kenyan Treasury bills, corporate bonds that are available for listing, or even the ones that are trading over the counter. And also very recently, we allow our investors to also buy and sell Euro bonds, all the Euro bonds that are listed on the African continent. The other thing is now this, on the buy side of the business, now we have discretionary funds. The main one is Mansa-X, and I think we'll be delving into that shortly with more detail. And then other funds that allow you to do money markets. So typically a money market fund would really be exposing you to short-term interest rate instruments, and equity funds, which would typically be exposing you to NSE, locally denominated equities.
We rarely get to hear about the other products. That's why it's important to also clarify some of the things that you do. Now, Mansa-X is one of your proudest products. Maybe you can tell us a bit why you're most proud of this product and what exactly does Mansa-X entail, and maybe a brief history to it that led to its formation.
Yes, Mansa-X is a product that we're very proud of, because when we started this product, it was actually client-driven. We started this product because clients actually asked us to create something that would allow them to navigate the bears and bullish seasons. And the local markets at the time were really just the local stock markets, local fixed income markets, which again were not really accessible to investors with anything less than 100,000 shillings, for example. And then maybe just real estate. For a very long time, investors could only invest in those three asset classes. And a lot of our investors were concerned because when these asset classes were not doing very well, then they had to tolerate bearish periods. And we had a really tough time in capital markets. And I'm sure Mokaya is that for over 10 years, we didn't even have a listing on the NSE. So if we didn't have a listing on the NSE, there was nothing to really infect the markets with any enthusiasm to trade local assets. It didn't help that the global financial crisis also created a very difficult environment for capital markets outside the United States, especially because even as the financial crisis was solved by capital injection by the Federal Reserve post-2008, a lot of this did not actually create value for frontier markets such as ourselves. So it's around that period, about 8 years later in 2016, that we started asking ourselves, why is it that Kenyan investors, a typical Kenyan has exposure to a lot of things globally. A Kenyan investor wakes up, he can access bar to go to the office, can order food online, he can go home and watch a movie on Netflix. But for some reason, when he goes to his financial advisor, the only investment assets he can be accessible to are really just 1 or 3 stocks on the stock exchange in Kenya, and maybe buying a plot somewhere outside the reach of Nairobi as some sort of speculatory investment. So we asked ourselves, why don't we then create a platform where investors can have access to financial instruments that are not necessarily domiciled in the Kenyan space? And that's how Mansa-X was born. Why we named it Mansa-X? We named it after Mansa Musa. Mansa Musa was and still remains the richest man who ever lived. And he was actually from the kingdom of Mali in West Africa. And it said that when he was going for his Islamic Hajj, he had so much gold that he actually donated along the way that he caused a depreciation in the price of gold for 10 years. So the reason why we named this Mansa, therefore, was really to allude to the fact that you can actually create a Kenyan fund that is naturally Kenyan, therefore locally domiciled, but with global exposure and still create prosperity for Kenyan investors with that angle. So a Kenyan investor who doesn't know anything about a stock like Raytheon, for example, can actually be able to invest in this fund and still get a return from the stock price movement in a stock that's traded thousands of miles away on the New York Stock Exchange. We got our license at the tail end of 2010 from the Capital Markets Authority. And since then, we've grown the fund for the last 6 years. And we are happy to see that our investors have actually believed in our dream and they have been very well rewarded for that.
So maybe you could give a bit of flavor in terms of how the growth has been the past couple of years in terms of numbers, and also emphasize the fact that it's regulated. I think who regulates the product, the people can get a bit of flavor on that.
Thank you for that. Yes, we started at zero because we started with our own proprietary capital at the time. And we really had to run with the fact that this was a concept that we were fairly certain would make sense to investors. And for that period, we have grown to manage, and now we're managing over 30 billion shillings under the Mansa-X funds. And we have grown to have a client base of about 17,000 clients. We are regulated and continue to be supervised by the Capital Markets Authority. They're the ones who gave us a license. And Capital Markets Authority, first of all, they're already the ones that license us to be an investment bank. So our investment banking license comes from the Capital Markets Authority. But the license to also run Mansa-X comes from the CMA. We started as what you'd call a money manager. So we started as a money manager. That's what the license was. That was the tail end of 2018. But now we are now categorized as what you call a special fund by the CMA, meaning that for all intents and purposes, we then operate as what you call a collective investment scheme, but within certain defined rules that are unique to funds such as Mansa-X. And very recently, Mansa-X was also licensed by the Retirement Benefits Authority to actually also invest funds on behalf of retirees and pensioners. Again, this is something that we are very proud of because we are also trying to push the idea that pensioners are also deserving of a higher than average return than what they have been exposed to for a very long time in capital markets in Kenya.
And then you have two funds, the USD and the KES. Give a brief breakdown on each fund. I think the KES fund was the first and then the USD fund. So maybe you can give a bit of context to what the two funds do.
Yes, when we started the fund, it was something that we grappled with. Should it make it a Kenya shilling fund or a USD fund? But we settled on the Kenya shilling fund because at the time that was easier for investors locally to understand. And the average return for the Kenya shilling fund for the last 5 years has been about 17.6%. But at the tail end of 2022, we also started the dollar fund. A lot of this came because of a lot of our clients. Again, we tend to be very client-driven and client-centric at SIB, where our clients had anxieties around a depreciation of their wealth because of the Kenya shilling losing value against the dollar. So that's when we started the dollar fund, and we have been able to average above 12% for the dollar fund since inception. So all these returns, we feel returns that have given a fairly reasonable above the average return in the market, proving the concept that exposure to asset classes outside the local ones without increasing disproportionate risk will always give a better return than what clients were exposed to for a very long time.
And then maybe a reminder to our audience, if you have any questions, just below the pinned tweet, you can type them and then you can also DM us and we'll take notes of those questions that you have for SIB and specifically for Mansa-X. So on Mansa-X itself, what kind of investors would be best suited to invest in that fund? And what's the minimum investment required, maybe to participate in either the KES or the USD fund?
I'd say any investor who's looking to genuinely diversify a portfolio. Because one of the things that we worry about as investment bankers, or one of the things that we see that make us very uncomfortable is seeing investors not necessarily being very well diversified. So if the stock market is doing very well, we see investors tend to then put all their eggs in one basket and go into the stock market. Even if they diversify by buying different stocks, they're still exposed to one stock exchange. If they're looking to avoid exposure to the stock market, they go and they buy bonds, again exposed to one sovereign debt and so on. In Mansa-X, we created a fund that creates genuine diversification. If I could just explain, we have different asset classes that Mansa-X actually invests in. The first one is equities, meaning we buy shares in companies from around the world. Then we have stock indices, meaning stock indices like the FTSE and the German DAX, the Japanese Nikkei, meaning lumped up stocks, and then we can actually buy the index in itself for our investors, again exposing investors to those different markets. We also buy and sell commodities on behalf of investors, so like natural gas, oil, and also soft commodities. In fact, very recently, even commodities like coffee and cocoa. We also have exposure to precious metals like gold and silver, and then ETF, exchange traded funds, again with exposure to asset classes from around the world. The kind of investor who comes into Mansa-X is the kind of investor who's looking to genuinely diversify their portfolio. And again, if you look at the kind of investors, we've had investors who are typically aspirational. They're very well exposed to what's going on in the world. An investor who, for example, right now we're on Twitter, now known as X. And this is, for example, is an investor who knows that this company exists. So why should we not allow an investor like that to be in a fund that can actually buy stock in Twitter, for example? So those are the kind of investors that we have. And we dare say most Kenyans tend to fit that profile. In fact, the only Kenyans we had actually not created a product for a very long time were really the Muslim clients. And therefore, last year, we actually created Sharia versions of Mansa-X. So now we have a Sharia version of Mansa-X Kenya Shilling Fund. We call it Mansa-X Kenya Shilling Fund. And then we also have the Mansa-X Dollar Sharia Fund. And again, this is really to show you that we have a lot of demand from all walks of life in Kenya for this product. Now, there's a great misunderstanding amongst the investing public that Mansa-X has a higher risk than your average fund. And we always argue that it's actually the other way around. If you're investing in a wider array of asset classes, you tend to have a likelier chance of having a higher return without actually creating the disproportionate downside risk. And like most of the other funds that typically would only have one or two asset classes that are domiciled locally. If you look at most funds in Kenya right now, almost all of them are biased towards investing in Kenyan government bonds. And we are one of the few funds, I believe, I'd say maybe the only one, that actually exposes investors to all manner of asset classes, therefore removing the over-reliance on one asset class. So an investor who's looking to genuinely diversify their portfolio with a reasonable return, Mansa-X is definitely the place they should be looking at.
And then in terms of investing, then how do the funds flow from the investor to you, then to investing, and then the other way around? If their funds are in their bank accounts, how do they get them to you, and then you get to invest?
There are very many ways they can reach out to us. They can reach out to us online. We have a website that allows them to actually interact with financial advisors. They can also call directly to the office, and we'll have our financial advisors guide them through the process, which is fairly simple. We have custody banks that we work with. Our main custodial bank is I&M Bank. So they will transfer funds from their bank account to I&M Bank. Then from I&M Bank, then we will then access those funds for purposes of trading. Withdrawing funds is also exactly the same. They will then reach out to us for withdrawal of funds, and we will then send the funds directly from our custody account at I&M Bank back to their account. And this is a fairly quick process. Typically, it doesn't take more than 48 hours. In fact, it's really dependent on the bank that they bank with, because our custodian is pretty fast, and I think I&M is one of the partners that we've worked with that has done an excellent job. The reason why we work with custodians is also for safety of client funds. From a regulatory perspective, custodians, typically the funds that they hold are not subject to the balance sheet of the bank. So they're really protected from anything that happens to the bank from a regulatory perspective. And this is one of the reasons we work with custodial banks. Very recently, one of the things that we've had to change about the funds is now including trustees. Trustees now work with Mansa-X to protect the interests of the clients. And this was really a regulatory reason because of how quickly and how big the fund has grown. The regulator insists that we must have trustees to really take care of the investor interest. And that's one of the things, again, we are very proud to be one of the first funds of our nature to quickly comply with the CMA on this request. So that's how an investor would join the fund. Withdraw funds very easy. Every investor who joins SIB to invest in the Mansa-X fund will always get a financial advisor, and that financial advisor becomes their go-to person for either top-ups into their accounts or withdrawals from their account.
A key question often, I think, and maybe need to emphasize it in terms of liquidity of the fund. I think a lot of people have previously invested in some funds, and when it's time to get the money out, then you find there's a huge hurdle in terms of that aspect of investing. Maybe speak to the people in the audience who are worried about that point when I need my money. What stops SIB from keeping my money, and how fast can I get my money? I think that's a real worry which we need to speak to.
Actually, I really like that we're having that conversation. One of the things that I have always mentioned to investors is a big concern for me personally when I started running this fund was a lot of investors in Kenya only ever talk about returns and nobody ever talks about liquidity. Nobody ever talks about how quickly can I access my funds. So at Mansa-X, the reason we invest in liquid assets, that's why we invest in stocks, we invest in bonds, we invest in metals, commodities, and we invest in this with brokerages around the world is exactly to solve that issue. We will actually often give up return for the sake of liquidity. So liquidity is very important in Mansa-X, and I dare say we are a very liquid fund, if not one of the most liquid funds in Kenya. We are actually able to pay investors as and when they request for their funds. So this is actually something that we actually specifically designed so that investors will never have to say, okay, I had a very good return, but I couldn't access my funds. That's one big worry we had. That's why even when we started, we actually bypassed assets like heavy investments in real estate that would actually jeopardize our liquidity position.
Very important. I think that's a very specific need for a lot of people. I think one aspect that people don't consider a lot, maybe given a background for a lot of individuals, is so often always that if you have extra liquid cash, you want to put it in land and real estate projects. And I've been to a couple of friends and realized even disposing of these assets is not usually easy. So I think it's good to also emphasize the aspect of when you're investing in any particular asset. And I think that's why we needed to deal with that question there. It's a good segue to the next question, which is what type of financial instruments are you using to yourself to invest? To the extent that they're not proprietary, you can share with us some of the insights in terms of what tools do you use to invest in some of these markets that you're invested in. Because you're invested in an array of assets from commodities to Euro bonds to all these stocks and all. So I think you can give us a flavor on some of these. And also at the same time, coming back to the same question, you've addressed it before, but maybe you can give us a few pointers on the various asset classes that you've been invested in the past and that you could be investing in currently.
That's a good question, because when we say, for example, that we have an exposure in a stock like Alphabet, I guess that's what you're asking. How do we then invest in that asset class? So if we buy stock, for example, in a certain company, we'll buy an instrument, say a US 10-year treasury bond. We can buy it in a number of ways. Of course, the most vanilla one is buying it in cash. All right. So if I have $1 million, I buy $1 million worth of this stock. But we also employ the use of derivatives. For example, we'll use options, and we'll use this for reasons such as hedging as well. Because in Mansa-X, we have long and short positions in everything that we hold. And this is one of the reasons why we also one of the most genuinely diversified fund. So if I'm long tech stocks, I will also look for stocks in the tech market where I am short, meaning that I will be looking to prevent myself from losing or rather wiping out my return if the value of tech stocks in the market actually fall. And typically then I'd look to be long, meaning I'm buying the tech stocks that are very well placed, but then also being short tech stocks that are not too well placed. So meaning that if the stock market started having a very unfair opinion, or maybe even a fair opinion of tech stocks, and the stock market started having a crash in tech stocks, then typically the ones that are not doing well will be the first ones to fall. And then we would actually make money from those stocks. By the time we exit the ones that we are long, then we have not lost any money, or at least not as much as a fund that had only invested in stock in a long position would be. I'm really trying not to be technical on this, but we employ, therefore, a mix of what you call cash and derivatives to create a very genuinely hedged position in the fund. And I think that's one of the biggest advantages of a fund like Mansa-X. If you look at, for example, during COVID, this is a time when obviously everybody would have said, we are done. We're not going to make any money. But during COVID, crude prices, for example, crashed. We actually saw what you call negative prices in an asset class. That was a new one even for markets. And again, as Mansa-X, we actually made a return in that year of about 15% net of fees in a year like that, purely because we were one of the few funds that could actually go short markets. For example, crude oil, we were short during that period, and natural gas, and we were actually able to be short oil and actually make a return from that. So these are some of the things that we can do. Then, of course, the reverse is also true. When we had something like the Russian invasion of Ukraine in 2022, we actually saw a sharp spike in commodities like wheat and natural gas. And again, we were able to take an advantage of that. What I'm trying to say here is it's not just a diversification in the number of asset classes that we trade. It's also a diversification in the strategies that we use to buy or sell those assets. And that's very unique to the Mansa-X fund. I don't know if Mokaya have explained that properly.
Yes, I think you have. For the audience who are not very technically savvy, going long a particular asset is buying it, and going short is when you think like it's going to go down in price. You sell it now and then buy it later, and then you make a kill from the difference. So I think that's a very good way that you've explained some of the areas that you've invested in. I see a lot of questions, so I may segue into questions in a few minutes, but I wanted to maybe quickly give you a bit of time to explain the returns in the various funds and how they've been a couple of years. Of course, past returns don't guarantee future returns. That's very important, but it's good to give a history of how the fund has been performing so far.
Very good open sheet here. So last quarter was one of our best ones. We had a very good quarter at the beginning of this year, where our annualized Q1 return was actually 22.48 after fees for the Kenya shilling fund and 13.92 for the dollar fund. Last year, our Kenya shilling fund returned 18.01% after fees and 12.1% after fees for the dollar fund. Top 10 holdings for the Mansa-X fund last year, actually for that was really a Eurobond. So, and I forgot to mention Eurobonds. We've had clients asking us why we have holdings in Eurobonds that seem quite significant. We actually reduced them by over 20% the last quarter. That's because, and I had mentioned this last year, because we do a lot of YouTube videos, and I'd advise a lot of our listeners today, whether existing or potential investors, to actually visit our YouTube videos and watch. One of the things I had actually mentioned was we actually felt a lot of Eurobonds, especially the Kenyan ones, were grossly undervalued. Some of the Eurobonds we bought last year had yields in excess of 20, and we were able to exit those positions at closer to 10%, you can imagine, Mokaya. So these were asset classes that we felt had been really ignored. So our top 10 holdings, we had Eurobonds, we had crude oil, we had exposure to Microsoft, we're in the S&P 500, significant positions also in gold, Nvidia, Novo Nordisk. Pharmaceutical companies have always done very well for us over the years. And I think I mentioned this a few times during our talks. Stocks like Novo Nordisk, Moderna, Eli Lilly, especially for Novo Nordisk with a drug like Ozempic. It's really sent the stock rallying, and we've really taken advantage of that. We saw commodities like cocoa, for example, in the first quarter of this year, cocoa actually accelerated by over 130% in value, which is quite significant. So you can imagine those kind of moves in markets have really helped the fund to make a return. On average now, looking back now over the last 5 years, our average return is close to 18% after fees. And I know a lot of people will say, we can get the same return by buying a Kenyan infrastructure bond. What you don't get when you buy an infrastructure bond is the fact that if Mansa-X allows you to have a return of 18%, it's the same 18% if you needed to withdraw tomorrow morning. But with an infrastructure bond, if it's floated at a coupon of say 18%, then when you're trying to sell it, you'd have to be subject to market forces. And typically, if you're not a big investor, that will quickly drop easily to even as low as 16-15%. And that's the difference with Mansa-X. So it's very important for investors to know that when they compare to bonds like IFBs, those bonds are only giving you that return, what we call yield in the market, if you hold them for those 10, 15, 20 years. And that's a big difference.
You spoke about fees, so it's good to speak about how much in terms of percentage of fees that you charge. And some people are complaining those fees are very high. So maybe you can tell them why you charge that fees that you charge.
Okay. This is something we've had to deal with from the beginning. And Mokaya, you can imagine we've had this question about fees even before we had a return. Okay. So we charge this fee purely because of how administratively involving it is to run a fund like this. First, from the type of traders that you have to hire, they have to be very proficient traders at their craft. And of course, that comes at a very heavy cost. The number of brokerages that we have to work with, we have brokerages We have brokerages locally. We have brokerages in New York, London, Dubai, Madrid. We have brokerages everywhere, and this comes at a very significant cost. The systems that we have to implement. All this, again, creates a fund that, yes, is expensive to run, but fortunately, that expense has been able over time to be proven to still squeeze a return, even with those fees that might look higher, still give a return better than fund managers who might charge less than we do, but still give you a lower return.
Maybe you can tell people a bit about how you do risk management and then how long your holding period is for some of the assets that you're trading in. After this, we'll switch to questions from the audience.
Okay, so risk management, of course, the overall risk management framework is really just governed by being within a regulatory space. So having your CMA as your regulator constantly inspecting the fund as they do, that by itself is already a risk management tool. And I think that's one of the most powerful ones. Then, of course, Mansa-X is domiciled within an investment bank that's very well governed from a corporate governance perspective. You have a very strong board of directors. And then under that board of directors, you have various committees that oversee the running of the fund. So you have the investment committee, you have the compliance committee, you have the risk committee. And then after that, then you have a portfolio manager like myself. That's my daily job, who I then have to manage a team of dealers. And within this team of dealers, you then have limits as to what they can trade and not trade, and the risks that they can take. And a lot of these are automated. In fact, our risk management system really automates what you call our stop loss levels, meaning that, for example, even if you bought a certain stock and as a trader you felt, no, I can hold it for longer because I think it will turn, the system will automatically stop it for you. So we have very automated methods of risk management. Again, a lot of these are not very unique to the fund. If you look at funds globally, they've used the same techniques for risk management, and we were really one of the first funds locally to really implement them in the way that we have. So we are very confident about our risk management.
A couple of questions here. One is for you. I'll start with this one. Why did you leave KCB? And I think I'll combine that with another one who says that you're the front man for the fund. So they're worried about key man risks. In case you ever leave, you can combine those and we can start there.
Why did I leave KCB? I worked for KCB. I worked at the trading desk of KCB, and I left KCB to join Bank of Africa at the time. At the time, I was really working for different banks in various trading capacities, and moving from KCB to Bank of Africa was really just a career move. That's all it was. And then in terms of key man risk, it's something that I worried about, especially when we started Mansa-X. But now I would confidently say that the fund has more than enough capacity to hold its own, whether or not Nahashon is present or not. We have very capable team working there, whether it's on the trading division, whether it's in terms of client management, whether it's from a compliance perspective, whether it's a board of directors, whether it's an investment committee. The fund is large enough to hold its own and therefore not necessarily dependent on Nahashon.
Someone is talking about, does each deposit have to stay in for 6 months? So once they put money in, do you have a period within which you have to restrict maybe people to investing in the fund?
Yes, and that's called a lock-in period. And the reason we have a lock-in period is because our fund is fairly liquid to allow investors to really withdraw at any time. But we find that a lot of investors would then lose a lot of value if they invest and then withdraw their funds far too quickly. But one of the things that we have actually never implemented is a penalty for withdrawal of funds. Okay, so we've had investors who withdrawn prior to 6 months. We don't have a penalty. The only thing we now decided is we will not then pay a return for that period because the fund has become fairly large. And if you then don't apply some sort of something that stops them from withdrawing before the 6 months are over, you can create some sort of liquidity issue within the fund. So that's the only thing. However, we are very open talking to investors if they need to withdraw their funds for any sort of emergency. Again, like I mentioned, every investor gets a financial advisor who they can speak to. And we're able to deal with this from a case-to-case basis. What I'm saying, Mokaya, is if you're trying to withdraw your funds because you have an emergency at home, you will not meet a stone-faced person at SIB telling you that we will not pay you anything because you needed your funds. We are very open and we deal on a case-by-case basis.
And then someone again about the management fee, like other product charge like 220, something like that. Now, 5%, is 5% purely management, or do you also charge on returns, by the way?
It's only the 5%, of course, is on the assets under management. So if you invested $1 million with us and now next year your funds at 1.2 million, yes, so the 5% is on the 1.2 million. So yes, you'd say 5% is on the entire assets now belong to you. Yes, we've had clients asking us about the 220 rule. Most hedge funds on Wall Street and around the world will charge that way. But our mod was really just to charge 5% because I dare say if you did the math for 220, you'll find that we charge less. If we charged our investors 2% of the funds that you invest with us and 20% of the returns that we generate for you, over time, you'll find that we'll actually make more. So we just chose to just make it simple for our investors. Again, a big part of the reason why we ran it like that is really what we were faced with in the local dynamic, and we had to work with the local dynamic as it. We did not want to create a very complex fee management system that will become very difficult for potential investors to understand.
Another question here is about, there's a promise of more transparent reporting. He says the nature of the report does not show the layering of gains from quarter to quarter. I think someone wants a bit more information in terms of how the gains were gotten during a particular quarter. Does that feels too proprietary, or is that something that you can promise? And then in that regard, there's something I've been asking also now in terms of risk metric. Is this something that you have in mind to release to investors soon?
So again, even our fact sheet has slowly evolved over time to deal with concerns from investors. If you look at our fact sheet, our top 10 holdings, initially, we never even used to say what percentage of the fund those assets constituted. And I think the last time I spoke on these Twitter spaces, Mokai, I don't think we had this. I don't know if we had this.
I should say that you do take feedback. As I think I've seen a couple of metrics being released over time. So yeah, there is an evolving. If you check the sheets over time, it's changed.
Exactly. So what we're trying to do is always just listen to our clients. If it's reasonable, we will provide it. So we started providing our top 10 holdings, and we started giving a percentage of exposure of that particular asset into the fund in terms of what that asset created as a return to the fund. That can quickly get very technical, Mukaya, and I'm not very sure a lot of investors would even want that. However, this is something that if that particular investor wanted, they can reach out, and that's the information. If it does not impede on our own proprietary passions, then we can give them that.
I agree. Someone is saying compounding effects to returns. Maybe you can speak to that. Like if they invest now and then the returns at the end of the year, you do invest them back, right?
The thing with Mansa is that ideally, every day is, in a sense, a compounding effect, or either positive or negative. Let me explain. If I start with $1 million today, and for the next 2 days, I gain 200,000, and then the next 3 days, I then lose 100,000. So if day one, the fund had earned a profit of 100,000, then day two, you'd still be earning a return on the same 100,000 that you earned the previous day. But also, if there was a loss of that amount the previous day, then you'll be working with less capital, because this is not a market guaranteed fund. That's why we like to expand the outlook of returns to a longer period. One of the challenges that we face with our Kenyan investors, they've been more exposed to straight line returns, where a lot of fund managers will typically invest in interest products. So if somebody invests in a bond that returns 15% in a year, then it's very easy to say 15% divided by 365, and therefore I compound that every year. But this is a fund that typically will give you of an actual gain over a certain period of time. And this gain can be plus or minus a certain amount. And that's why, even for investors, it's the same reason why we really discourage very rapid withdrawal of funds unnecessarily, unless, of course, you have an emergency, because then what happens is investors keep subjecting themselves to the cycles of market forces. So when it comes to compounding, that's a question that it gets very mathematical very quickly. But if you look at it, yes, from a yearly perspective, it's an easier question to answer. That yes, if we finish a year at 18% and you start the new year with an 18% return, then of course, then the next year it compounds on that naturally, because essentially we invested your principal plus return in the second year. But if you then bring it down to a daily basis, it gets a lot more complex.
There's a couple of questions. I think this one speak maybe to the average listener, maybe who may not be very savvy in financial markets. He is called Festus, and he wants you to break it down for him. He gives you 1 million shillings today. In 1 year, in terms of returns, how much, given the history, like how much do you return in a year?
So last year, if he had given us 1 million 1st of January, 31st of January, he'd have earned 180,000 and 10,000 shares. give or take,
Is that after fee?
after fee.
All right. So keep it simple
Yeah.
like that for them. That's what they wanted. They wanted to
And
understand.
that $1,000,000 shilling would have earned you 180,000 at the end of the year.
Simple like that. Okay. All right. And then in terms of risk, what's the risk that you lose your capital? I think the person is worried about the risk of losing the initial capital in case of loss.
First of all, when it comes to risk to capital, be very careful with a fund manager who says that there's no risk. Anytime you engage in capital markets, just like any other business, be very careful with anyone who tells you that there's no chance you can lose anything. But one of the things you can do is check their historical performance. So Mansa-X has been in existence now in our 6th year, and we have never lost a client's capital. So we have proven the concept that if you're well diversified, if you're constantly buying assets that are not correlated with each other in terms of market movement, then you're more likely to get a return without ever having to lose any of your capital. And we've proven that for 6 years. So I cannot answer that in a forward way, but I can only answer it based on how we've been able to perform for the last 6 years. So be fairly confident to invest with an investor who has been able to demonstrate the capacity to give me a return consistently for 6 years without denting my capital.
Yes, someone here alluded to some other Kenyan startup that was offering 18% guaranteed returns. So I think very important to remember that there are no guaranteed returns in market, and whoever is offering you guaranteed returns is almost always picking that from someone else. I watched a documentary on Madoff, and I think that's what he did. To guarantee returns, he was letting people, it's a pyramid scheme. So the new people give you money, and then you give out people guaranteed returns. So there are no guaranteed returns in investing. You should expect to lose some. The best thing you can do is assess the capabilities of the investment managers that you have and make sure that you're invested with people with a credible track record who have a good way of you getting money back. I think that's a very important thing to remember.
If you look at our fact sheet, Mukaya, just to on your trail of thought there, is that our fact sheet will show you that some quarters are better than others, and others underperform other quarters. That is exactly how our market operates. And I think our fact sheet is a really fair representation of how dynamic markets can be in terms of ability to give a return or not. If we had a fairly consistent straight line, I think it would have to be the luckiest people out there.
Yes, definitely. So risk is an inherent part of markets. So kindly remember that as you also invest. And then someone is asking here about the daily real-time flow returns. I don't know. There's meaningless information. Like you don't want a minute by minute of how your account is doing. It detracts from the main business of trying to make money. So maybe you can speak to that a little bit.
When you said months, this was all the things that we grappled with. Some investors want, can I get a daily report of how much my fund is making? If you did that, I guarantee you, even the investors who ask us that, if we give them a real-time view of their account, they would have sleepless nights. It's a very tough job. And that's why you pay us 5% to handle that pressure. And that's why we came to a compromise and said, okay, fine, we will not give you yearly statements, we'll give you quarterly statements. At least then you wait only 3 months to get an idea of how your account is performing. And we feel that's a very good trade-off for those investors who are fairly anxious about whether their returns are okay, and the ones who have a longer term view. We found that a quarterly return was a good trade-off. A daily one would just be far too much for anybody, at least most of the people that we've ever engaged with.
Yeah, I agree. There's always that risk of often. You also get distracted from the business of generating returns. And also, if you're investing in something that you have to keep looking at every day, I feel like you need to maybe change what you're investing in. Investing should be something that stresses you that much. You're paying professionals to handle some stuff for you. So there's a frequent mention of something called Forefront. So maybe you can describe how that's different from Mansa-X. I understand it's a product within SIB. So maybe you can speak to that a bit.
Okay. So Forefront is one of the subsidiaries of SIB. Forefront is what you call a robo-advisor. So we pioneered a product that allows essentially algorithms. It's like artificial intelligence, really, that then picks out an investor's risk appetites and horizons and so on, and then suggests an investment for them. So think of it as financial advisors who are robots. That's what Forefront is. And it's our wealth management and can suggest various investments for you based on the profiling that they have for you. And that's what Forefront really is.
Basically a robo-advisor. It's in the interest of leveraging technology to make sure that you're delivering good investments to people. So I think it's very important for people to understand that robo-advisor. But there's no robo-advisor at Mansa-X. It's you making decisions, right?
Yeah, with Mansa-X, you have the advantage of speaking to an actual human financial advisor who will advise you, and then you can then check whether that investment makes sense for you or not. You can have 1,000,000 shillings and maybe 250,000 would be suitable for Mansa. Can we put 300 in this and so on? That is why we are also one of the few fund managers that has really pushed for financial advisors to be certified with the Chartered Institute of Securities and Investment, CC, so that they are not just salespeople to you, and they are also financial advisors, and they actually genuinely advise you on whether investing in certain assets is safe or proper for you or not. And that's one of the things that we also really encourage, that listen to your financial advisor. That's very important. And we have hired a lot of them to make sure our investors are well covered.
Very important also. Very good emphasis also point that you should search for a financial advisor before you make investments. Some of the investors don't want to pay for advice sometimes, but it saves you a lot of money. Just ask people who've lost quite a bit of money in some products which are not suitable for your investment. So even the IFDs that are out there, they're good for investing, as you say, Nashon, but it's good to compare what's the trade-off I'm making in terms of risk, because a lot of people need to sell those IFDs after a couple of months, and it's quite a big problem to sell them off in the secondary market. It's not that easy to sell.
Interrupt you, but that's why when you ask me the liquidity question, I said that's actually a very fantastic question that a lot of Kenyans never ask. A lot of Kenyans will ask you about return, but nobody ever asks you about liquidity.
Yes, very important. Oh, liquidity, risk, returns, three components that go together very well. A question here, someone is asking if you have competitors in the region, and how did you set the hurdle rate?
We do not have a competitor in the region, not in the way that we run this fund. And we set our hurdle rates. I'll be honest with you, we were probably a lot more ambitious when we started in terms of returns, because we were much smaller then, and we were really comparing ourselves to a lot of hedge funds globally. But the local dynamics also made us realize that one of the things, and that's one of the realizations we came to have in Kenya, is that I think you can actually categorize most Kenyan investors as conservative investors. So we had set the hurdle rate much higher at 25% for the Kenya shilling fund, at 15% for the dollar fund. But over time, we have some investors who've received those kind of returns, but we feel that right now we like to think of most of our investors as conservative investors. And that's why, again, when I answered the question on the 220 fee management structure, I mentioned that we really had to look for something that's a trade-off between something that makes sense as a business running this kind of a fund, and a trade-off of how investors in Kenya actually understands and perceive investments to be like, and what actually works within a dynamic that they already understand.
Yes, lots of questions coming in. I see the questions. So I think what we need to do now is to maybe have a quarterly brief with you where you can have a chat with investors who are interested. We need to do this more often so we can be able to get some of these questions. One final question, perhaps you can allow the audience, is on taxes. What are some of the taxes applicable to Mansa-X as someone invests in them? Maybe top of mind, quick taxes and maybe fees. Are there other hidden fees someone may also be surprised by at some point? I think that's important. So someone is asking, you compare that maybe to MMS, which have some withholding tax implications.
So first of all, we already pay the taxman VAT on our fees. Already we pay 16% on our fee management, which is 5%. So we pay another 0.8% as taxes, which is already quite significant. This actually goes to reduce your return as an investor. So your return is actually lower by 0.8% because of the VAT that we pay. Then within the fund, that we already pay withholding taxes for any asset classes that we buy or sell that are subject to withholding tax. So that's it's fixed income tax or fixed deposit products or it's share dividends and so on. We already pay those taxes on your behalf. Now, the return you actually receive as an investor has already had all those taxes subjected to them. Now, our fund is actually not a guaranteed return investment. And that's why it's not subject to withholding tax. When you compare with an MS, if they are buying a bond, for example, or they are investing in fixed deposit, then typically you are already expecting 10% at the end of the year, so the government will tax you 15% of that. But in Mansa-X, you are subjecting yourself to market dynamics, and the return you actually make would most closely be referred to as capital gain. And we don't have capital gains taxes in Kenya for capital markets products. In addition, with our new CIS accreditation that we are the tail end of concluding, we are then also not subject to certain taxes, and this will accrue as a benefit to investors. But of course, nowadays taxes become such a sensitive topic that we are very careful to answer that question without adding the disclaimer that please check with your tax advisor to make sure that you're well covered in case the taxman comes for you.
Important. Do you have a few minutes for a couple of questions, or should we wind up here?
Let's try and wind up because, like I mentioned, we were in between something else. But I'm happy again to have this more often because any chance to get to engage our investors is a good opportunity for us.
And markets are actually closing in the US soon, so you need to check some of the positions there. Thank you so much for your time today. So maybe it can give you time to give us your closing thoughts and also tell people where they can find you and find your fund also.
Thank you. Thank you, Mokaya. You engage very well and I really appreciate it. And I'm really appreciative of the clients who've actually, put in the time to listen to us this evening. You can find us on J Quad Towers. Now, J Quad Towers is the original ICA building. We're on Kenyatta Avenue on 16th floor. So you can come there and just ask for Mansa-X, information on Mansa-X. You'll be assigned a financial advisor very quickly who will guide you on how to the next steps in terms of opening an account. Our email is clientservices@sib.co.ke. Shoot an email there immediately if you have any question that you feel I did not answer this evening, and we'll get back to you as quickly as possible. And our website is mansa.sib.co.ke. You'll also get a lot more information there, mansa.sib.co.ke. And any question that you have and you feel that you'd want a response as quickly as possible, shoot again to clientservices@sib.co.ke. We will personally respond to you within a few hours.
Thank you, Nashon. So for all who've joined us, thank you so much. This is one of the most well-attended spaces. We'll try to make regular basis on markets since there's quite a bit of interest in terms of investing in products that people can invest in. So thank you for your time. Thank you, Standard Investment Bank, also for allowing us to have these spaces today. Thank you so much, Nashon.
Asante sana, everyone, and have a lovely evening.